Hey there, Jesse Moore, Pickett Street Properties. We want to talk today about why the bank might ask you to stop paying on your mortgage. This is something we run into often where sellers come into us and they're confused because they're trying to do the right thing. They're making their payments. They're screaming up and down asking for help, and the bank's not giving it to them. And the bank, as a solution, is recommending that they stop making their payments on their mortgage. So let's talk about why the bank is doing that. So no loan exists by itself. It exists, if these are all little loans, they exist actually in a portfolio of loans. And so this is how the bank sees your loan. It exists in a portfolio, and this is a happy little portfolio because everyone in this portfolio is paying their mortgage. And so let's imagine that this is your loan right here. We're going to draw you in there. So that's your loan, and you're screaming up and down asking for help, saying, listen, I've lost my job, I have a medical issue, I'm going through a divorce, whatever the situation is, I'm in a position where I have to sell my home, and I can't do so from an equity position, and I need help. I need, even if you don't need to sell your home, you may need to reduce those payments. And so you're screaming up and down for help, and they're not asking you, they're not giving you any help. Essentially, the only option they're offering you is to stop making your payments. So let me illustrate why they're asking you to do that. So let's say you stop making a payment. As soon as you stop making a payment, stop making your payments, all of a sudden it's very easy for the bank to see you in this sea of otherwise performing assets. And so what they have to do, when you stop making your payment, it actually hurts the entire portfolio. So what was once a performing and happy portfolio is now has a bad egg, a bad apple, and they need to remove that from the portfolio to make that good again. So what they end up doing is they will actually move you over to a new portfolio, a loss mitigation portfolio, where you are one of many other types of loans that are not making their payments currently. And so by doing that, what they're actually doing is they can eliminate you from this portfolio. That makes this portfolio happy again. They move you into this sea of unhappy loans, and now some new options open up. So once you hop into this loss mitigation portfolio, these are the kind of options that open up for you. And before I go over those, here's what you need to know. Banks operate on policies and guidelines. If you're making your payments, that's a serviceable loan. They don't have a lot of policies and guidelines to help you out. Once you stop making your payments and you move into a new loss mitigation portfolio, all of a sudden there's a whole new handbook for them to open, and they include options like these. So we'll start with HAMP. This is a government loan modification program. They could actually just do a traditional loan modification. These used to be really hard to get. They're getting a little bit easier to get. HAFA is a government program for short sales. You could do a traditional short sale. In very rare cases, and depending on who the investor is, they might do a principal reduction. Or depending on their scenario, that bank may have a private program, like Bank of America has a cooperative short sale program that is a little bit different. So you can see there's a lot more options that open up once you stop paying your mortgage. And so it's funny, as a real estate agent, I will never tell you, and I can't tell you to stop making payments on your mortgage. The bank can tell you that, and I just wanted to explain why that is. Why it is that the bank would ask you to stop making payments on your mortgage. And the reality is that it opens up all these options to you, and that allows the bank to help you out in your situation. So that's it for today. Thanks for listening.